Good afternoon, everyone. My name is Luke Tannen, and I'm the Executive Director of Chicago Innovation, an organization that supports local innovators and entrepreneurs across all industries, big companies and startups through a variety of events and programs. We are also a very proud partner and customer of Wintrust. Now, on behalf of Wintrust, I'd like to welcome you all to the second installment of Wintrust Wealth Management's panel discussion series on the economy and financial markets. During today's event, the Post-Inauguration Economic Outlook, our speakers will cover the economy and the investing landscape in light of the presidential and congressional election outcomes, proposed tax and fiscal stimulus plans, and the latest developments with the ongoing pandemic. Now, before I introduce today's speakers, I'd like to let everyone know that if you have a question, you can send it to us via the Zoom Q&A while the event is taking place so our speakers can see what is on your mind and try to respond to it. Also, keep an eye out for a few polling questions so we can learn more about you, the audience, and your perspectives as well. Our moderator for today's discussion is Tom Zadar. Tom serves as chairman and CEO of Wintrust Wealth Management, which recently surpassed $30 billion in client assets, overseeing 4 operating business units: asset management, trust, investments, and 1031 exchange. Tom is in his 15th year with Wintrust. He joined the company after a long career in financial services that included investment banking, management consulting, and then 9 years with ABN AMRO's LaSalle Bank here in Chicago. Our panelists joining Tom include Jason Turner, who is the head of multi-asset strategies for Wintrust Asset Management Group and is a member of the firm's investment committee. He's primarily focused on interpreting economic and market conditions to create investment solutions and strategies for institutional and individual client portfolios. Jason's a regular guest on WGN's Business Lunch Hour radio program. He does frequent public speaking engagements on the markets and economy, including recent presentations to the American Diabetes Association, Illinois Government Finance Officers Association, and the Illinois Restaurant Association. And then also on the panel today is Dan Rahill, the Managing Director and resident tax expert with Wintrust Wealth Management. He's often published and quoted in media outlets, including the Chicago Tribune, Crain's, ABC7 TV, Yahoo Finance, as well as the Illinois CPA Society's Insight magazine. Dan's a former chairman of the Illinois CPA Society and serves on 3 academic advisory boards and several nonprofit boards and committees. Great group of speakers today, and with that, I will turn things over to our moderator, Tom Zadar, to get us started. Take us away, Tom.
Okay, thank you, Luke, and good afternoon, everybody. We've got a lot to cover, so I'm going to just jump right into this. So let's start with a review of the key external forces that will impact the economy and the markets this year, beginning with the Consolidated Appropriations Act, or we'll call it the CAA, that was passed in late December. Dan, with everything going on lately, this legislation was passed rather quietly, but this is a $2.3 trillion package of federal funding and COVID relief. What are the most significant pieces of this deal that the business owners and investors on our call should be aware of?
Well, Tom, you're right. It was passed quietly, 5,593 pages worth. But it extended many of the provisions of the CARES Act from March of 2020. And I think the centerpiece of the program that applies most to businesses is an expansion of the PPP program, the Paycheck Protection Program, $284 billion for eligible entities. And there have been changes, positive changes to the program and changes not so positive, just a few of which the most important ones are the program. This iteration of the program will go through March 31st. So another 2 months from today. The maximum loan size has been decreased from 10 million down to 2 million. But food and beverage and food service companies, restaurants, because of the help from Senator Amy Klobuchar, who spearheaded this, they get extra benefits, which is much needed by the restaurant industry. The maximum eligible business size has been reduced from 500 to 300, but 2 very positive developments in the new act. Simplified loan forgiveness for loans under $150,000, a very simple process to get those loans forgiven, and deductibility of expenses that relate to the PPP forgiveness. There was some question, it was a bit of a lightning rod back a few months ago, a debate whether those expenses would be deductible or not. They will be deductible retroactive to the first date of the CARES Act. So that is the centerpiece for businesses.
Yeah, thanks, Dan. That was very good news. PPP funding has certainly been a great help to many of Wintrust customers during the pandemic. So it's great to see the further investment there. Now, what are the other aspects of the CAA that our business owners should be aware of, Dan?
Well, a hidden gem, I call it a hidden gem because it's not talked about as much as it should be, is the Employee Retention Tax Credit, ERC, Employee Retention Credit. This has to be talked about a lot more with business owners. It has been expanded, and it's a great opportunity for businesses. They can get up to $14,000, $7,000 per quarter for each of the next 2 quarters. It runs out June 30th, 2021. And for businesses with up to 500 employees, you can take $14,000 if you qualify. So I highly recommend all businesses take a look at the measurements for who qualifies and look into the program. One of the reasons it wasn't as well known during the CARES Act last year during COVID relief was the fact that if you had taken a PPP loan out, you could not otherwise qualify for the ERC. You can now, and that's retroactive going back to the effective date of the CARES Act. So you can qualify for both. You just can't use the same payroll in calculations of both, but you can qualify. So that's greatly expanded. 2 other things I just want to mention that are brand new under the CAA that weren't in CARES: shuttered venues operators grants. So theaters, music venues now will be able to get grants of up to, and there's been $15 billion reserved for that, so that's welcome, as well as for business owners, and this is unique in the law. You are now allowed 100% tax deduction when you go out for meals, as long as those meals are ordered in a restaurant. That's up from 50% deductibility previously, and that goes through 2021 and 2022. So go out and run up those tabs on those business lunches.
Should be good for our restaurant customers.
Yes.
Thanks, Dan. Okay, shifting over to the individual side, how might this act affect individuals, Dan?
Well, again, like the PPP loans on the corporate side, on the business side, for the individuals, what we've most been talking about are the refundable recovery rebates. And obviously these phase out at higher income levels. However, for individuals single individuals under $75,000 of income, married couples at $150,000 and below, you'll be able to get refundable recovery rebates of $1,200 for married couples and $600 for individuals, plus an additional $600 per qualifying child. What's important about these refundable recovery rebates is that you can true up on your tax return that you'll file this April. If you are underpaid on the amount of your rebate and your check that came in the mail or electronically in your bank account isn't quite what you expected because it was based on 2019 income and not 2020, you can true that up and you'll be able to take additional amounts on your a credit on your income tax return. Just 2 other things I want to mention for individuals that the CAA has extended charitable contributions for those who do not itemize. 90% of people who file tax returns do not itemize. So this will apply to 90% of the people that do file tax returns. $300 under the CARES Act was allowed as what we call an above the line deduction. So you'll be able to deduct that. What's interesting about the CAA is that it's expanded that and clarified retroactively to the date of the CARES Act that married couples will be able to take $600. That was a question before, and that was made clear under the CAA. And a permanent change from the CARES Act is the medical expense deduction. Medical expenses up to 7.5% of AGI. So if you exceed that number of your adjusted gross income and medical expenses, you'll be able to deduct those. Previously, it was 10%. And finally, discharge of indebtedness on principal residences, the last bullet point here.
Yeah, and Dan, I'm not familiar with that one. Who might that apply to?
Well, during COVID, we've had a lot of situations where lenders have forgiven all or part of the debt on family mortgages.
Okay.
When that happens, that generally triggers something called cancellation of indebtedness, COD, cancellation of debt. And that's taxable income generally to the borrower. What the CAA has put in writing and has articulated very clearly is that through 2025, if someone has part or all of their debt on their mortgage of their principal residence forgiven by a lender, then that is not taxable income to those individuals. Now, there are some caveats. There's a ceiling of $750,000. Under the CARES Act, it was $2 million. That's come down to $750,000 is not taxable income, and a homeowner cannot be declaring bankruptcy. That's another exception. So we are seeing frequently that a lot of these loans are being forgiven or readjusted. People don't have to worry now about getting a 1099 at the end of the year and having to pay tax on that.
Got it. Okay, that's helpful. Thank you, Dan. So let's look forward now and move on to potential future legislation. Now, it was not quite the blue wave that many predicted, but Democrats do now control the White House and the House of Representatives and the Senate. So Jason, how do you see things playing out in Washington on the legislative front?
Well, I agree, Tom. It wasn't quite the blue wave that was predicted. I'd characterize it more as a blue ripple. The Democrats have narrow control of the Senate, and really on a tiebreaker from the vice president's vote as president of the Senate, because it's split 50-50 down the middle of the aisle. This likely constricts the ability for the Democrats to make sweeping legislative changes that were proposed or hinted at during the campaign season. It's going to lead to one of three different scenarios that we'll see play out in Congress. And we already started to see play out within the last week with a group of moderate Republicans meeting with President Biden to try to negotiate a middle ground. And that negotiation process is step one in those three different scenarios. The other one is to do away with the filibuster rules. That's the real impediment to large legislative change right now. Just about anything outside of reconciliation could be filibustered. Those rules can be done away with or changed or altered. And finally, that reconciliation process that the president hinted at during that meeting with the 10 Republican senators, but also that others have hinted at along the way and has been used in pretty much every presidential administration for the last 20 years. You could pass certain elements of the American Recovery Plan through reconciliation. Those initial critical comments from Republicans and one moderate Democrat are sort of my evidence that the door is open for some collaboration, for finding some middle ground, but it's sort of a tenuous tightrope that Congress is walking. We could see a quick swing back to the partisan divide that characterized the last several years.
Yeah. That makes sense, Jason. A lot going on. There's been significant back and forth of late, especially between, as you said, the 10 Republican senators and the White House with President Biden and Vice President Harris meeting. I think it was just last night with that group. A lot going on. Dan, what is your take here?
Well, that's interesting. Last night, for the last 48 hours, the news media has been focused on the 10 Republican senators who are going to meet with Joe Biden last night. Just a couple of hours ago, the results of that meeting have been made public, and Joe Biden has rejected the Republicans' counter proposal. So it does look like at this point they are moving forward, the Democrats, with revenue reconciliation. What Joe Biden has proposed under the American Rescue Plan is, and I'll just summarize the four biggies: stimulus checks of $1,400 per. The Republicans had countered with $1,000 with lower limits of phase out. That was rejected. Employer paid leave. So employers paying leave of $1,400 per week per employees. That, however, will be reimbursed to the employers through tax credit regime for those employers with less than 500 employees. Unemployment insurance, increasing that from $300 a week to $400 a week through September 30th. So extending that from end of March through September 30th. That's part of the Biden plan, as well as the minimum wage. And that is something we should talk about too. Joe Biden and his administration have proposed to increase that from $7.25 per hour to $15 per hour.
Yeah. So a pretty extensive, $1.2 $9 trillion plan here, Dan. And as
Yeah.
Jason noted, this blue ripple environment exists after the narrow Senate leadership by the Democrats. In your mind, how do you handicap this? How likely is it that you think this plan is the President Biden plan, if you will, as currently proposed, how likely is it to pass?
Well, Jason referred to it a few minutes ago for one conservative Democrat out there, and everybody. I think he was referring to Joe Manchin, and there's a couple more: Kristen Sinema of Arizona and John Tester of Montana. All three have come out and recently called for more targeted spending programs. And today, this afternoon, I read an hour ago, Manchin came out and said he does not support the $15 an hour minimum wage. He could maybe live with 11. So, how do you handicap it? I think a number of these provisions will make it through. We'll see the Republicans come back to the table because revenue reconciliation process is going to take much more time. It's much more complicated. So that will take time to go through. And I'll just leave it at that.
Yeah. Well, in the Republican plan, Dan, it seemed like the two large items that were not included were the minimum wage and then the state and local government support. Is that a fair statement?
That's a very fair statement. And minimum wage, Tom, there's a very strong argument. Some are making a weaker argument that it can be included in revenue reconciliation, but revenue reconciliation has to do with taxes and the balancing of the taxes with the budget. And minimum wage is not technically a tax. Democrats have argued that, well, it could be considered a tax against those companies that don't pay the minimum wage, but that's a very weak argument. So there's certain elements of this bill that won't make it through if it goes through revenue reconciliation.
Right. And, Dan, we pulled the next slide up here. That was my question to you is, any other potential tax changes under discussion,
Right.
from the Biden administration?
Right. Well, piggybacking on the back of the American Rescue Plan, Joe Biden has said he's going to follow that up with further legislation towards the end of the year. We expect it. He said he would articulate what the plan was in February, which is now here. But what we expect to hear from President Biden in February is on the screen here. During the campaign, they had proposed to raise the top tax bracket for individuals from 37 to 39.6. The top corporate tax rate, they have proposed to raise to 28% from 21. And the estate tax lifetime exclusion, they've proposed to reduce that. Although they haven't said, they've hinted at it coming down all the way to $3.5 million per individual, which was proposed by the Obama administration back in 2009, 2010. It's currently at 11.7 million in 2021. And if I were to handicap those right now, again, it will be towards the end of the year, the Build Back Better recovery plan. I have not seen an acronym for that, but I bet you it starts with 3 B's. The top tax rate, I think that will have a very good chance of passing and getting some Republican support. The deficit has grown out of control, and quite frankly, the individual rate is due to return to 39.6 in 2026 anyway. So that's destined to go back up anyway in 2026. The top corporate rate, that's not scheduled to sunset, but I do not believe, and listen to a lot of commentators, that because of the state of the economy right now and the fragility of it, that they will be successful in getting 28%. But I've heard 24, 25 as being realistic and possibly acceptable to the Republicans. And finally, the estate tax lifetime exclusion that's 11.7 million and has received a lot of press. That's due to revert back down to 5 million inflation adjusted in 2026. So it's going to come down anyway, and that's for sure. Definitely that will come down. Will they bring that down sooner than 2026 is the question. Would it come down in 2022? It very well could come down to 5 million inflation adjusted in 2022. I do not think it will go all the way down to the $3.5 million level, but let's keep an eye on it.
Yeah, Dan, your question of when actually just came from the audience. We have a question from Caleb Lendy about the chance that any of these tax changes might be made retroactive to Jan 1, 2021.
Caleb, thank you for the softball. I appreciate it. It gives me a chance to say something that a lot of commentators don't talk about. A lot of commentators talk about the fact that tax legislation that increases taxes won't be retroactive, that the government doesn't do that. And in fact, they have. Under the Clinton administration in August of 1993, the Omnibus Reconciliation Act raised the lifetime, the estate tax lifetime rate, the rate on estate tax from 50 to 55%. So it increased the estate tax in 1993, and that was retroactive from August when the law passed back to January. So it can be done. It's been tested in the Supreme Court in 84 and 94 in Supreme Court cases. You can do it. Now, do I think it's going to happen, Caleb? No, I do not think it's going to be retroactive. I caveat that by saying it's certainly possible, but I think it would be on a go-forward basis that these significant changes would happen to, tax rates, estate tax exclusions. I'd say they're going to do it going forward. Again, pointing to the fragility of the economy right now and unemployment. I don't think they'll take a chance and do this retroactively.
Thanks, Dan. So there is precedent, but highly unlikely in light of the economic environment.
Right.
All right, great. Shifting to Jason, question about trade. The prior administration was very active on the global trade front, in particular using tariffs to advance the U.S. agenda. Jason, what do you see happening under the Biden administration with respect to trade and international commerce?
I think the Biden administration is fairly clearly articulated, both during the campaign and since taking office, that our stance relative to China will remain fairly strict from a trade perspective. However, the approach is likely to change, maybe somewhat significantly. Certainly, there'll be fewer restrictive tariffs as the Biden administration is going to rely on more multilateral action to try to shape Chinese trade behavior in the global marketplace. But there'll be significant focus and pressure. I think it'll manifest in a couple of ways. One, leveraging allies and coordinating action on the global stage would be both less disruptive to the global trade picture, but also more impactful in making changes to China. Think about it like a balloon. If you squeeze one end, the air just moves to the other side. If you squeeze it from all sides, it's got to reform or pop. The other one is backing away from Trump era tariffs could actually be beneficial to the American manufacturers and other businesses that rely on imports from China as imports or components of their products. Presented to a number of different manufacturing organizations over the last year, and the constant theme or question I hear is the stranglehold that these tariffs are putting on their supply chains. And I think alleviating that supply chain pressure is a positive in the change in approach to China.
Okay. And thank you, Jason. I'm checking the chat and the Q&A here, and you ticked off at least one, answered one of the questions there. So perfect. There's also been talk, Dan, about changes to the retirement plan legislation. What are the most significant and, again, more likely changes that you see coming?
Well, Tom, and I don't disagree with this potential change that the Biden administration has proposed, and that's to no longer allow deductions for retirement plan contributions, but rather you would get a credit. And so if you contribute to your 401k plan, you contribute to a deductible IRA, you would now get under the Biden plan a 26% tax credit, refundable to all taxpayers. And why do that? Because the system currently benefits those in the highest tax bracket, which are the biggest savers. This would enable lower tax bracket individuals to get the same credit, the same dollar for dollar credit as anyone else, and promote more savings at those lower tax brackets. I don't disagree with that personally. And then the second thing that could come through that affects retirement plans is they've talked about raising, again, the RMD rate. RMD stands for required minimum distribution from a retirement plan. And right now at age 72, you need to take, under the law, you're required to take, subject to a pretty high penalty, distributions calculated based on your life expectancy. The House a bill was entered into the House back in August. I call it Secure Act 2.0 for those that know what the Secure Act is, Retirement Act from 2019. And that would raise the RMD rate to 75 and also increase the catch-up rate in addition to over 50 individuals getting $6,500 catch-up rates for 401k plans, et cetera. That would raise that for people over 60 would get $10,000 additional amount. So those are two interesting changes that very well could be made to retirement plans.
Okay. Terrific. Thanks, Dan. Let's move on to the third major, let's call it external force that's shaping not just our economic and investing landscape, but our everyday lives in obviously profound ways, and that's the pandemic. Jason, where do things stand with COVID-19 today, and what's the prognosis for 2021?
Well, I would be remiss talking about COVID-19 if I didn't note a grim milestone we passed some 2 weeks ago now. The total fatalities related to the COVID-19 pandemic here in the United States surpassed the number of American service personnel killed between December 7th, 1941 and September 2nd of 1945, the breadth of World War II. And most concerning, it occurred in about a quarter of the time, 350 days versus almost 1,400 days. The winter surge in cases obviously put a strain on hospitals. We saw it most notably in California and some of the problems that we're seeing there. That's moved across the country as we moved through late December and January. But I'm pleased to see in the last several weeks, since peaking in early January, the total number of cases is measured here by a 7-day moving average of new cases has fallen nearly 45% from its peak. That is a significant decline, actually the largest percentage decline we've seen here in the United States since the beginning of the pandemic. So far, vaccine rollouts have not really meaningfully decreased the hospitalization or fatality rates. Those are both running on a multi-week lag to cases. So we'll see if those start to tail off, and we're seeing it just barely today here in the fatality rates over the weekend extending through today, that we're starting to see a decline in those numbers as well. That's a net positive, particularly since we've had some difficulty in rolling out the vaccine here in the United States. We're not the worst. We've certainly not been the best at rolling that out. But as those vaccine delays are mitigated and we start getting more and more of the population vaccinated and moving more towards that level of herd immunity, if you will, any sort of meaningful impediment to economic recovery starts to fade farther and farther into the rearview mirror, along with COVID infection rates.
Okay, and that leads us into our first question to the audience concerning the ongoing economic recovery. So let's pull up our first polling question. And it's basically, how do you see the U.S. economy performing in 2021? We got various percentage of GDP growth, gross domestic product growth in this calendar year. So please take a moment to click one of the circles there, and we'll tally it up in a minute. I've done that. Okay, let's now talk about recent and potential legislative changes and what the state of the pandemic mean for our economy. So Jason, does the latest round of stimulus, again, priority one for the Biden administration, provide the right kind of support for the economy?
I'd say yes and no. The economy broadly needs some level of support to keep the recovery trudging forward until we get broader improvement in consumer activity and a much lower rate of COVID infections. However, we've emerged in this K-shaped recovery, and it's created an environment where some parts of the economy need significantly more help than others. Dan mentioned it early on with the extra support for restaurants that was so critical in his comments earlier, but also low wage earners, we're talking about the bottom quartile of wage earners, still have unemployment that's north of 20%, according to Federal Reserve data, while high wage earners, those in the top quartile, have already returned to full employment. They're down below 5% at this point in terms of the unemployment numbers. Small businesses also are closing at an alarming rate. They appear to require significantly more support than larger businesses. Some of the adjustments to the PPP program have started to address that, but more direct addressing of that situation would be necessary in a stimulus. Direct to consumer checks are good. They're easy for both sides of the aisle to get behind, but they don't have the same results as more targeted support. And I think that's some of the challenges you've seen from many of the moderate senators, both Republicans and Democrats, that have emerged in the last few days. When we had the last round of stimulus checks, we saw the savings rate skyrocket here in the United States. A savings rate north of 30%. That's astounding. If we go back through the early part of the 2000s, our savings rate was down in the 3 and 5% range. More normalized would be 7 or 8%. So 30% savings rate means that money was given to consumers and just put into the bank. It wasn't spent. It didn't generate economic growth. So more targeted support to lower income earners who typically spend more of their paycheck and need more support would actually create more economic benefit. And then state and local governments. I know this is a contentious point for the two political parties, but regardless of how well or how poorly a municipality or a state was run before the pandemic or even during the pandemic, they're all in need of additional support due to the upended tax revenue situation they find themselves in. Municipalities can't issue debt to cover budget shortfalls like the federal government can. So they need that federal level of support to step in where their revenue is going to come in well below budget for 2020 and likely for 2021.
All right. Okay, before we get to the next question, let's see, Paul, can you pull up the results of our first polling question? Okay, again, what do you foresee for the U.S. economy? It looks like about half the folks said modest GDP growth between 0 and 2.5%. Very interesting. In the next group, it was 36% solidly, so 2.5 to 5. And then the rest of the histogram here, very interesting. We have not quite as optimistic as we maybe are reading about. Jason, what level of economic growth do you foresee for the year ahead?
I think we start with consensus estimates, and this result's actually a little surprising. So that's good for the comments, I guess. The consensus estimates are looking for the full year GDP growth number for the United States to come in around 4.5%. That'll be revised as we move forward throughout the year, obviously, but it's likely to manifest as a bit of a roller coaster when we look at quarter to quarter GDP growth. We're coming off a quarter in which we booked 4% at an annualized rate in the fourth quarter. That ended the year for 2020 at a decline of 3.5%. That's actually the largest decline in the post-World War II period. With some of the challenges we've seen with the winter surge of virus cases, the first quarter is likely to see a lower number, but then we'll accelerate through the second and third quarter until we level off in the fourth quarter. So if we plot this course that's on the slide here on your screen, we are fairly well positioned to a resumption of more normal GDP growth patterns as we move into 2022. There are a lot of variables here that could upset the apple cart and just a couple that could turbocharge it. So the risk is asymmetric to the downside. And I think that's probably where some of our audience percentage results ended up. But the current consensus estimate that I would more or less agree with would be for 4.5% GDP growth for calendar 2021.
Yeah, great, Jason. I think the CBO just came out with something similar to that today, if I read it right, 4.6 or so for the year. Dan, what do you foresee for economic growth in 2021?
Tom, I'm about as accurate on prognostications as Pexitani Phil. For those of you who realize today is Groundhog Day, he saw his shadow. 6 more weeks of winter in Chicago. Shocking.
Oh, fun.
No, I see what the prognosticators see. I can read the reports. I think it's going to be 3 to 4% for the year. I think we've had so much stimulus with more to come, and with the vaccine, barring any surprise new variants that are going to throw us off, and we've been surprised before. I'd see 3 to 4%, and then starting in 2022, maybe returning more to a little bit lower level on GDP2 as we recover through 2024.
Yeah, thanks, Dan. So speaking, Dan mentioned the winter. Jason, the latest wave of COVID-19 this winter has had an impact on the economy. What do you, more near term, what do you expect here in terms of economic growth in Q1?
Now, I think we saw it in the December results that have come out over the last several weeks in terms of consumer and retail activity. We see it in the flash data that is measuring January activity as well, particularly early in the month. There's been a decided slowdown in consumer activity here at the beginning of the quarter. It's partly COVID restrictions and largely fear-based changes in the short-term behavior of consumers. There's not enough impacts here to make it a risk case for the slowdown we saw last year. but it's certainly going to slow economic growth in the first quarter. We're going to see January come in at slow numbers. It will be slow to ramp up in February. The slower vaccine rollout plays into this a little bit, as we won't see that kind of skyrocket jump as we move through February into March, likely occur later in March or even into April or May. But we're still making a case here, not for a decline in economic activity, but just for slower growth for the quarter.
Got it. Well, speaking of growth, inflation is always a concern when so much money is pumped into the system, as we've seen over the past 12 months or so to fight the pandemic. Let's tee up our second polling question to the audience and ask what folks think inflation might look like in 2021. Please take a moment to respond here. Okay. We'll hold off on addressing inflation until we get our polling results. But Jason, you noted in the past that consumer spending is really the lifeblood of the U.S. economy. What do you expect, or when do you expect Americans to resume a more normal spending pattern?
Any sort of return to normal scenario for the American consumer is closely linked to consumer sentiment. I've been pretty consistent on that since early last year, which itself is linked to COVID-19 infection rates and risks. The rollout of vaccines is the largest factor that can impact or make a quick return to normal possible. Broadly speaking, and using current vaccine projections from the CDC or the WHO, consumer activity in the US is likely to start looking a little bit more like normal, at least normal levels, sometime in Q3, maybe early Q4. It just sort of depends on how efficient we are at this next wave of vaccine rollouts. However, some segments of the economy, cruise lines are a glaring example, are likely to see a significantly slower recovery. The travel industry as a whole, but cruise lines in particular, even with everyone vaccinated, it's going to take a long time for cruise ships to ramp up to full schedules and full capacity. It's also not correct to assume that consumer spending is ever going to resume its pre-pandemic composition. Activity is likely to continue throughout the recovery, and the absolute level of consumer activity is going to return to a more normalized level later this year. But the disruption the pandemic has imposed on the way Americans spend money, and some trends that had already been emerging over the last decade, really got accelerated and amplified in the last year and will likely continue. Think online shopping or curbside delivery, gig economy type food delivery services.
Yeah, absolutely. Let's see if we can pull our second polling question results. Paul, how do we do? Okay, steady. So we, to the audience, thinks 55% steady, 1 to 2% inflation in 2021. Maybe a little bit more to the upside. I think maybe our bankers in the audience are influencing interest rates here. But Jason, what's your take? Is inflation likely to be a concern? Let's talk about in the near term in 2021.
Sure. The short answer is no. Inflation's not likely to be a concern in 2021 in the near term. We're coming off multiple years of below Fed target inflation. So in a normalized environment, we weren't even hitting 2%. Yes, we've injected an astounding amount of money into the economy over the last year. We're standing on the precipice of doing more again. On an adjusted basis, comparing that with the amount of support as a percentage of GDP or percentage of national debt that was injected in the Great Depression, we're not quite there yet because the American economy is much, much larger than it was in the 1930s. So there likely is more room and capacity to absorb more stimulus payment in the economy without injecting runaway inflation. The Fed also changed policy last year, which got a lot of press for about 3 or 4 days, and then everybody went quiet on it. But it's actually a landscape change for the Federal Reserve, and no longer will 2% inflation or whatever target they set be the trigger point for Fed action to start raising rates. The Fed is going to allow inflation to float above their target, understanding that multiple years and multiple quarters of below trend inflation will likely need some runoff above trend inflation, so that the target is more of an average now. With that said, because of the year-over-year comparables, we are likely to see inflation top 2% sometime during the spring or early summer, simply because the prior year comparables were so stark because of the pandemic. I think for the complete year, our invited guests are correct in the majority that we're likely to see inflation in the same realm we've seen it in years past, in that 1% to 2% range.
Okay. So you're with the consensus, it sounds like there. Okay.
Yep. Good consensus.
Yeah. Let's shift gears and talk about the markets. And we'll start with our final polling question. So Paul, if you could pull that up. As we all know, the stock market surprised us quite a bit last year. Despite the damage done to the economy by the pandemic, the S&P finished up more than 20% in 2020. So how does the audience expect the index will finish in 2021? Please take a moment to click one of the bubbles. And we'll come back to this in a moment. So let's talk about what all of these external developments mean for the markets in the year ahead. Jason, what do you see as the relevant market or investment themes for us in 2021?
I think looking backward to 2020, if you had told me at the beginning of the year, excluding any sort of pandemic, we were going to see equity market returns near 20%, I would have thought you were crazy. The consensus within the investment strategist world has been we're in a lower return environment for longer. It's important to note too, for those 2020 returns, leadership was incredibly narrow. We're looking at a handful of stocks that actually drove that performance for the indexes. If the recovery persists, the rest of the market has to catch up. So if we see a broader economic recovery, we're going to see more performance like we saw towards the tail end of 2020 and the early part of January here and this year. And that's areas like value stocks relative to growth stocks, small cap stocks relative to larger cap, and international relative to US should outperform as those areas of the market catch up. And I mentioned on our last panel discussion back in the fall that we were expecting the equal weighted version of the S&P 500 to outperform the market cap weighted, and it did so through the tail end of the year. We're also expecting in the fixed income arena, because of the rate environment we find ourselves, we're low for even longer. We've been talking about low for longer and a search for yield for a long time. The reality in that fixed income market is we're likely low for a long period of time. The search for yield is going to become even more difficult. So you need to start thinking about total return as opposed to income within portfolios. Think about tax management or after-tax returns being the more meaningful bogey. And diversification, risk management, and a long-term focus, as I seem to write almost every week in my weekly note, are what matter most. It sounds boring and repetitive, and the asset allocators talking about diversification and risk management, but over the long term, those are really the determining factors of whether you meet your investment goal or not. Did you manage risk and did you diversify appropriately? Yeah.
And Jason, it does sound repetitive, but I'm with you on the refrain. I think, for the audience, you run our multi-asset strategies at Wintrust, and I've been talking about global diversification for a long time. Can you just speak to that? I mean, is that sort of the same theme there with respect to this narrow view in terms of the leaders in 2020? Do you expect better global performance in the year ahead?
I do. Those global indices that you alluded to, be it the MSCI EFA index that measures the developed world, the emerging markets index, those global markets are populated with a higher percentage of those sectors that were unloved in 2020. Financial stocks, industrials, energy companies, those things that didn't see the blowout returns that technology and communication services companies saw in 2020 have higher weights in those international indices. And that's the base case for why we think international stocks are likely to perform a little bit better on a relative basis going forward.
Okay, great. And here's a related question, from the audience, Jason. There's a sense in some quarters that the market in general is overpriced. Looks like Rita Bradkey in the audience wonders if the devaluation of the dollar is causing an artificial rise in stock prices as a whole. What is your take here?
Well, certainly no question that there are elements of the market that are overpriced. With the run-ups we saw last year, you see stocks like Zoom up hundreds of percent and other technology companies running away. They've outrun their financials. It's on expectation more so than it is on valuation. Fluctuations in the dollar have played into that to some extent, but normally when we see dollar fluctuations driving the market, we're talking about the market as a whole as opposed to narrow elements in the market. So I wouldn't necessarily blame the dollar for those valuation run-ups in the narrow leadership we saw to date. Now, if the broader market recovery continues apace and and continues to push higher and does so at an accelerating rate, when we can start talking about a weakening dollar being part of the equation there to driving those returns.
Right. Okay, before we move on to the next topic, Paul, can you bring up the results of our polling question and see how our audience, 5 to 20 is the half of the voters, and then down. Nobody sees a repeat of 21% see a repeat of 2020. Okay, interesting. Well, we're hopeful that that we do see that 5 to 20% up in 2020. Jason, what is your take on market expectations for the year ahead in terms of S&P returns?
I would be hopeful to see it in the 5 to 20 bracket. I think if we take the 50% and the 36% and combine them right there as 86%, average out around 5%, I would say that 5% expectation for the equity market, even though that seems very low for historical perspective, is right about where we're looking at large cap U.S. stocks as represented by the S&P to be for the full year, based on where we're at from valuations, where we're at from tailwinds and headwinds in the economy. I think the idea of a lower equity return expectation for the year is warranted.
Understood. Okay, let's talk about what all this means in terms of planning ahead. So starting with implications for business owners. We had a number of questions and concerns related to potential estate tax changes, Dan. Let's see, Gerald Murphy, Joe Gleba, Frank Cerrone, and Kevin Deeth all had similar questions around potential estate tax changes and the implications for family businesses. Dan, based on what we anticipate in terms of the most likely, legislative or policy changes to come, what steps should business owners consider taking this year?
Yeah, well, Tom, I think everybody that asked that question is spot on. I think it is the number one focus, should be the number one focus of business owners. So small business owners, people that own their companies, should be looking at the estate and gift tax changes. The lifetime exemptions due to sunset in 2026 for sure. And that could be moved up. So this would be the year 2021 to get your estate plan in order to take advantage of the 11.7 million times 2 for a married couple, so $23.4 million, and pass that on to the next generation if you fit that profile. Gifting, setting up charitable trusts, etc., should all be reviewed. The second thing I would say that is very likely this year for business owners is an increase in rates, and I simply call that bracket management. The income tax brackets will be going up for both businesses and individuals in the future. I said earlier, I don't think the corporate rate will go to 28 as proposed by President Biden, but I think it could go to 24, 25. I think that's pretty likely. The individual rate would go to 39.6. I think that's pretty likely in 2022. And capital gains rates, while they won't do away, I don't think with the capital gains preference for individuals making over $1 million, which is Biden proposal, I think rates certainly could go up for capital gains to maybe 26 or 28%, like they were 20 years ago. So there is precedent for that. So I think those two areas, estate planning and bracket management, should be a focus for corporate business owners.
And again, as we talked about earlier, we likely have a little bit of time because most likely they wouldn't go retroactive on this. So 2021 would be your time to plan and put things in place, because taxes are going up, in one way, shape, or form, probably in 2022. So now's the time to plan and execute.
Right.
All right. Thanks, Dan. And then are there other tax law changes that are possible, maybe not as likely, but what other things should business owners be keeping their eyes on?
I think these will not happen, but let's watch them very closely because they've been proposed. The elimination of what we call the step up in basis at death, where when you inherit an asset at death, it steps up the fair market value or the market value 9 months after death. That would be a huge change that could wipe out generational wealth in a generation or two. So that's a big one, eliminating step-up basis. Don't think it's going to happen, but it could. It's being discussed. And finally, grats, slats, and dynasty trusts. You lawyers and accountants out there have heard those terms before, but simply stated, there are a number of strategies using trusts that individuals and families use to pass on wealth to the next generation. Those are being reviewed and targeted by the administration, and those definitely could go away. So definitely 2022 should be a year, 2021, and it prior to 2022 should be a year to visit estate planning and talk to your tax advisor, your estate planning attorney, your wind trust strategist to determine what to do with your estate plan.
Yeah, I think great advice, Dan. Thank you. So now let's shift to the investor perspective. Jason, what should investors be thinking about in terms of the state of global markets as we move forward in this year, 2021?
I think it's two key things. First, and I mentioned this already, reduce your return expectations going forward. Low rates and headwinds to growth are providing significant impediments to both fixed income and equity returns on a go-forward basis. Valuation levels, particularly here within the United States, for a lot of companies don't help. They provide a difficult outlook for the coming years too, that you won't have that kind of multiple catch-up that we saw actually emerge in the last several years. The second point would be to embrace diversification. Again, I'm sounding boring, but it's the only free lunch in investing, really. And current global markets are well suited to a diversified portfolio. You're seeing near 11 years of outperformance for the S&P relative to global and international stocks. That's the longest period of outperformance for the US relative to international that's existed within the timeline of those indices. We've also seen the largest and strongest outperformance of growth relative to value over the last 5 years that has ever existed in investing, including the pre-depression periods. So those themes of diversification and reduced expectations are the best advice I can give from an investment perspective, outside of things that aren't really in your control.
Yeah, also good counsel. Speaking of advice, Jason, I got to ask you one more question from the audience. And this one may be resolving itself real time in the markets over the last 2 days. But Jason, what advice do you give folks interested in GameStop, AMC, or any of these other internet fueled names right now?
I kind of anticipated this would be coming, but I would say there's a fundamental difference between gambling and investing. Investors purchase securities based on research, based on fundamentals and valuation. Gamblers just take chances, and maybe they're measured probabilities, but they're chances. Betting on some internet fueled stock name, and GameStop was down 60% today, 60% today, would have easily worse odds than anything you could do in Vegas, even those penny slot machines. Or if you want to go into DraftKings and place a couple bets on the big game this Sunday, both of those are more likely to pay off for you than trying to invest in a internet fueled stock name that's just as likely to crash through the floor as it is to jump through the ceiling.
Thank you, Jason. I assumed you would be differentiating between investing and gambling or speculating. We are 5 minutes from the hour, so we're going to wrap things up for today. But I wanted to thank everyone who joined us this afternoon. Thank you to our panelists, Jason Turner, Dan Rahill. I'd also like to acknowledge our own Eric Munger, who pulled together most of the questions and a lot of the background work for today's event. Thank you, Eric. As noted previously, we'll be conducting these panel discussions quarterly, and our next session will be in late April. In the meantime, you can follow Jason's thinking on the economy by reading his weekly market update, which you can see by following Wintrust Wealth Management on LinkedIn, or requesting your Wintrust relationship banker or advisor to send you a weekly email with the market update. And Dan Rahill's published articles on legislative changes over the past year and their impact on the business owners and investors can also be found on our website, wintrustwealth.com, under the guidance section. And finally, a recording of today's event will be available on Wintrust's YouTube channel, as will a transcript on our website. So I want to say thanks again to everyone. Stay safe and have a great rest of your week.